Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. Let's go ahead and get started. We have a lot to go over here today. Before I do, just a quick disclaimer. What we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So the market has continued to consolidate, and we want to talk a little bit about the consolidation, where we see some strength, where we see some weakness, because we've been talking about this market as being a relatively healthy rally, at least compared to the rally that we saw from November to February. So the question that we want to try to help answer is, as over the past couple of weeks, as markets have consolidated, how healthy is this current rally? We want to get a sense for, has things changed with respect to the markets and the different sectors and how we look at the market? So we want to take a look at how healthy this rally, where we're seeing some concentration risk, specifically in the FAANG stocks, which is where we see a lot of the strength. That's where we see a lot of the growth in this particular market. So we want to talk a little bit about that, what risks we see with that. Then we'll take a look at some of the travel trends. Travel trends being a pretty important metric at the moment because we're seeing an additional bifurcation in leisure versus corporate travel and how we are looking to play that bifurcation. We see that bifurcation not only in the travel space, but pretty much any of the reopening trends. So if you look at restaurants, if you look at cruise lines, if you look at travel stocks, there's this bifurcation even within retail. So this bifurcation is really some of the opportunities and concerns that we see with the market. So it's important that we understand this bifurcation and see some examples for how to trade them. And so we'll look at some of the trade ideas and answer any questions questions at the end if we have some time. So the question that I predominantly want to try to help answer today is, have we reached a market top for now? We've had a bit of a consolidation over the past few weeks, and we're trying to see where markets are headed next. My name is Tony Zhang. I'm the chief strategist here at Options Play. Let's go ahead and get started. So we'll first take a look at the S&P 500. Now, the S&P 500 over the past couple of weeks have moved only sideways. We see the momentum has pulled back a little after reaching that overbought territory. However, for the most part, both the daily and the weekly have held its 20-day exponential moving average. So this is predominantly good for the strategy of buy the dips and looking for a continuation higher both on the daily and the weekly level. But right now, we still have some major resistance levels above. You have that 318 high, which is the last high it made on Tuesday of last week. We have the 323 high that it made a couple of weeks ago. Those are two major resistance levels that this market needs to get back above before it can really continue its bullish continuation or bullish trend. At the moment, this is much more of a neutral view as long as the market stays below those two levels. Now, the S&P 500 is about to open up around 314 today, so certainly looks like this week we can try to make a crack at 318 and 323. So those are the levels that we're paying attention to. And we have a bit of a very tight, narrow range here between 318 and roughly, let's just call it 308. So you have a 10-point range on the SPY that if it breaks below, we're starting to look at perhaps some bearish trends starting or the beginning of a bearish trend. But as of right now, markets are starting to trade higher and looking to retest that 318 level. So those are the levels we're paying attention to. Now, there's a pretty big drastic change between looking at the S&P 500 versus looking at the NASDAQ 100. Now, this is a trend that has started to emerge over the past few weeks because the technology-heavy index has, if you look at this chart, number one, the chart looks much cleaner. You have a very clean uptrend, and the uptrend is littered with small pullbacks, but each time it pulls back to that 20-day moving average, you get that buy the dip opportunity. Every single time that the market touches that 20-day moving average, it becomes a buying opportunity. And right now, it is starting to break out again to that all-time high. This corresponds to 10,000 on the NDX, NASDAQ 100 index, and looks like it's about to break out here today. So new all-time highs for technology. This is not a surprise to us because we're really seeing this rotation into technology. This didn't start this year. This certainly did not start with COVID-19. This started well before COVID-19. But COVID-19, I think, is only going to accelerate our rotation into technology as the broader leadership. So, over the decades, different sectors have dominated the markets. And we clearly see over the past couple of years that technology is going to dominate the market cap and the markets. So this is a trend that we should continue to follow and see out and look at the names that are suitable for trading in this particular emergence as technology as a new leadership in our markets. Now, one of the things I want to point out is that we've been talking about the health of the market rally, and we've been seeing some significant gains in the equal weight S&P 500 index, which is healthy for both the market cap, which is the S&P 500, and the S&P 500 equal weight index that both rally. When they both rally, that's generally signs of a healthy market rally. Now, for the most part, this this equal weight index has kept up with the rally, but over the past couple of weeks, it has started to lag behind. So this is a concern of ours, especially with the market up about almost 1.5% at the open, but the equal weight index relatively flat. This is telling us the equal weight index is starting to lag behind. The market cap, the larger market caps, is starting to rise again. This, that's usually unhealthy as you head into a market top. That's usually what causes the euphoria at a market top. We're not quite there yet, but it's important to see this trend starting to emerge. Small cap, on the other hand, this is also another sector or segment of the market, if you will, that we have said that as it rallies is healthy for the market. This has still continued. So despite the equal weight not following, small cap is actually leading the market. Small caps are up over 1.5%, close to 2% pre-market here today versus the S&P only up about 1%. So small caps continue to lead this rally, which again is healthy for this market. So not many concerns at the moment, but that equal weight index starting to lag behind, over the past couple of weeks is starting to show perhaps some cracks in this rally. But for the most part, this rally is still looking fairly healthy. I do want to point out here, we've been talking about gold for quite a few weeks now. We've been talking about this 164 resistance and how it's been building this triangle. Yesterday, it broke out above that 164 resistance, and this could be the catalyst that gold needs in order for it to continue moving higher here. So we do see some bullish moves here on gold. Some of it, especially if you look at the dollar, we've seen a weakness in the dollar over the past few days. That's really what's caused this, I would say, decline here in gold. Increase here in gold. Same thing here on crude. Crude starting to break out above that $40 level here. This is the WTI continuous contract starting to break out, certainly starting to retest that gap and filling that gap. So right now, if it can manage to break above this 41.5 level, that certainly would potentially put crude back into that $50 level next as the next upside target here. But 41.5 is a major level where it fills that gap that we need to keep an eye out on. If it gets rejected here and maybe breaks below that 20-day moving average, that would certainly be bearish. If we just even move a couple of bucks above that gap, then we put ourselves in a much more bullish view here in terms of crude. So very important level to keep an eye out for if you're trading any of the energy names. VIX actually yesterday declined below the 20-day moving average. So we've been talking about VIX, selling VIX into these spikes, and every single time it hits that 20-day moving average, it's been a good time to sell volatility. Yesterday was the first day. Again, it broke back below the 20-day moving average. It's still above 30. So volatility is still remaining fairly elevated. So for this, what this tells us is that as VIX remains relatively stable, on a stable trajectory lower, but remains at an elevated level, especially if you compare to the levels trading in January and February, where it's almost triple the value that it was back in January and February. These are environments that you generally want to sell volatility. So for option strategies, this is for selling puts, selling put credit spreads. These are the types of strategies that are suitable when volatility remains relatively elevated for this type of market. So VIX giving us a better indication as to what option strategies to take. Front month VIX currently trading at 30, 3-month VIX trading at 33. So VIX remains in backwardations, which is a risk-on environment, meaning we can take long positions in equities with this type of structure here on VIX. Now, one of the things I do want to point out, and something that we've stopped looking at for the most part, but has seen a bit of a resurgence over the past couple of weeks, and I want to talk about the markets have been talking about this second wave of coronavirus, and predominantly it's due to the increase that we've seen in terms of cases of coronaviruses across the world, as well as the recent uptick we've seen in terms of the number of deaths. But I want to point out here is that, and the markets are fairly sensitive to this, right? Because Apple announced on Friday around noon that they were shutting down 11 or 12 stores in 4 states, which is a relatively small number of stores if you consider Apple's global revenues. But the markets sold off pretty heavily on that news as a risk that perhaps some of those states may go back into shutdown, maybe more businesses in those states. And those states, the states that they did shut down in were pretty large states from a economic perspective. They account for a fairly large percentage of our GDP. So, but the one thing that I do want to point out is that if we look at the countries that have a number of cases that are greater than 1.8% of tests are positive, the countries that have greater than that are predominantly countries that never experienced really a first wave. So it's not really fair to call the current resurgence or the current surge, if you will, in cases that we see in South America and India and Brazil as what we call a second wave. This is really more of a countries that had lower cases of coronavirus now catching up, if you will, to the developed markets that had the huge number of cases originally. So we do expect these countries to eventually flatten the curve, and I think this is part of why the markets have ignored this recent surge, if you will, in coronavirus cases. It's not that it's a second wave, it's truly more of the first wave for a lot of these countries. Right now, I think the only country that's really concerning for most investors is Brazil. Because Brazil has not locked down their country as much as others. As you can see, their death rate is significantly higher. Chile also, but Chile has a relatively small population compared to Brazil. So Brazil is really the big elephant in the room here as far as coronavirus, but right now, the markets are not reacting to this, but it is something that's very sensitive. It is something that we need to keep an eye out on in terms of new states that are emerging. But out of the 50 states, we only see 4 states that have seen a significant uptick in terms of cases. But again, 3 of those states are states that did not experience much of a original surge in coronaviruses to begin with. And so we feel that they're more catching up rather than seeing a second wave. Now, one of the things I do want to point out that is something that we've been talking about for a while, but is becoming more and more relevant again, is the market share of the FAANG stocks. And if you look at the performance of the FAANG stocks outside of the S&P 500, as you can see, it is very, very strong compared to the S&P 500, both the total market and the S&P 500 itself. Now, one of the things that has changed substantially over the past few years is the market share of the FAANG stocks out of the S&P 500. It is now approached 24%. We've never seen leadership of just a few stocks taking up 24% of the entire market cap. This is concerning because when we talk about leadership, we want to see leadership that's not very narrow. We want to see broad leadership. That's why the rally that we saw from March to today, we said that when equal weight is participating in the rally, when small caps is participating in the rally, when there's sector rotation across the board, that's healthy. That was why we had the confidence to say buy these dips, despite the economic devastation we're seeing on the backdrop. And a lot of people were kind of concerned that you can take on buy the dip opportunities when the economics were looking so weak. But as again, this trend is starting to turn a little bit, as we saw with the equal weight. And it's not in itself a reason to go short the market. It's not a reason to be concerned at the moment. It's just something to keep an eye out for, because the more stretched a few stocks can be and dragging the markets higher, the more of a risk of the next pullback being more violent. And this is really what's caused some of the more violent pullbacks we've seen, is because we've seen so much concentration in just a few stocks. So when those few stocks have a bad day, or the market sells off and everyone sells those few stocks, and you have this concentration, that's really what causes some of the violent pullbacks that we're seeing. So this in itself is not going to provide any bullish or bearish ideas in itself. It's just meant to give you an understanding as to how the market structure is currently working, that we can't just compare the S&P 500 today to the S&P 500 a couple of years ago, because the markets are very different, where just a very few stocks now take up almost 25% of the market, versus even just last year, it was only around 18%, hovering in the 16 to 18% range. So this is going to cause some issues here in the market going forward, but it's important to understand that. The second thing I want to point out is really the uptick in terms of leisure versus corporate travel. Last couple of weeks ago, before we had the sell-off, 2 weeks ago, travel stocks were the darlings of the market. We saw some pretty phenomenal gains in some of the airlines. We had back-to-back 10% days on Delta, on United, on all of the major airlines. But one of the things that we should point out is that the uptick in terms of travel hasn't been significant, especially if you think about, normally we're looking at about anywhere from 2 to 2.5 million passengers a day. We're still looking at just shy of just a little bit over 500,000. So we're talking about 20% recovery of the original number of travelers right now. So not a huge uptick in terms of travel. Certainly did not reflect the gains that we were seeing in the airlines. This was one of the things I warned about a couple of weeks ago, was that I felt that the airlines were moving a little too far too fast, and we saw those crashing down immediately. But as airlines become, and as travel stocks become another a point of interest, one of the things I want to point out here is that there's a huge bifurcation now between leisure travel and corporate travel. So pretty much all of these gains that we've seen in terms of pickup in travel has been almost 100% been in leisure travel. So if you think about stocks that cater to leisure travel versus corporate travel, there is a bifurcation right now. And that's why, because of this type of data, in terms of airlines, we'd much prefer some of the more domestic airlines that are catering to leisure travelers. You can think about Spirit, you can think about Southwest Airlines, you can talk about Allegiant. These are all domestic carriers that cater almost 100% to leisure travel rather than corporate travel, versus United, Delta, American, heavily make most of good portion of their revenue from corporate travelers as well as international travelers, at which this point both international and corporate is really down almost 95% at this moment. So we prefer, in terms of looking at travel stocks, the more domestic airlines, discount airlines that cater to the leisure travelers. And, Southwest Airlines really shine out of that group because of their strong balance sheets, their lack of debt, and they've paid off, they've restructured some of their debt recently. So this is really, from my perspective, out of all of the airlines, one of the more attractive ones. And if you're going to look at Southwest Airlines, one of the ways that I would play this is using selling put credit spreads. So again, volatility at this moment still remains relatively elevated. So if you try to buy a call option, they're fairly expensive. A better way to play this, in my opinion, is to use a put vertical here, where you're selling something like a 34.5, 31 put spread. You can collect about $1.45 here for a $2.50 wide credit spread. You'll collect $3.50 wide credit spread. You'll collect $1.45, which is just shy of 40% of the width between the 31 and 34.5 strikes. So those are the types of premiums that you want to collect. And in this higher volatility environment, you're going to be able to do that. So those are the ways that I'm currently looking at playing some of these bifurcations that we're currently seeing in the market, using stocks like Southwest Airlines that is likely going to recover a little faster, at least looking at the data that we're currently looking at, compared to some of the more legacy airlines. Another one I want to point out is American Express. Now, for those of you that follow the payment space, you've noticed that American Express has lagged behind Visa and MasterCard substantially. And partially this is because American Express heavily caters to the corporate travelers, and corporate travel is clearly at a big decline. So we believe that at least American Express is not going to participate in the next rally higher in travel stocks. So if you're looking at some of these travel stocks, this is an example of a stock that may not do as well outside of the corporate travel space. So keep an eye out on that. If you are long American Express, or if you own this particular stock, be aware of these types of trends for your investment decisions. Now let's take a look at technology. So, we've talked about technology being a leader well before the coronavirus. Now, one of the things that coronavirus has done is accelerated this trend, this shift to technology, because it shifted away from other sectors such as energy and perhaps even real estate and financials. And we've seen this leadership in technology, and we think this leadership is only going to continue to grow. And you have to think about the mega cap names like Apple, Microsoft, Netflix. These are the names that are going to lead this shift higher. But we are also seeing a whole new class of technology leadership, and such as CRM, Salesforce, Work, Team, DocuSign, and even some of the cybersecurity stocks. Those are the types of stocks that are going to now emerge as potential leaders of the work from home and the new shift in trends that we are currently seeing from the technology space. And Microsoft is clearly one of the leaders in this particular space, both in their Microsoft products in terms of Office and Windows for working from home, but more importantly also their Azure business. As more and more businesses move to working out of the cloud, Microsoft Azure is one of the leaders in this particular space. Microsoft and Amazon effectively dominate this particular space. So Microsoft breaking out above that 196 level, starting to break above 200 level. This is likely going to continue to see gains. Not only do we see Microsoft leading the market, it's leading also the technology sector. So that's certainly one of the names that we're paying attention to. Another name, for those of you that pay attention to, that have looked at Netflix, Netflix recently broke out to all-time highs yesterday. So streaming stocks clearly still continuing to do very well, especially as it seems like COVID-19 is going to be here for a while in terms of social distancing. Likely, this may actually change the whole business model of movies and movie theaters and how movies get released. We're seeing more and more movies getting released on Netflix and streaming platforms rather than in the theaters. So, this trend is likely going to continue. So Netflix breaking out above 455, certainly strong for Netflix. But if you want to play a name that isn't at all-time highs, we actually quite like Disney, because Disney here has a pretty strong bullish trend here that we're seeing this, and it's just trading below its 20-day moving average, so it's potentially primed for another buy the dip opportunity. It is trading just below its 20-week moving average, but it is hovering right above that 20 and 200-week moving average, so it is at a pretty pivotal turning point here. You have a fairly small amount of risks to the downside, because if it just goes down to about 108 or so, that would certainly put this bullish view out of it would negate the bullish view, but you still have a lot of upside here into that 132, 136 range. So you have a risk to reward ratio of closer to about 3 to 1, almost 4 to 1 on this particular bullish play here. So from a risk to reward perspective, I like Disney much more than Netflix. Biotech, this is something that I've also been talking about for quite a few months now, as biotech has ranged between this 127 or so and 135 level. It created a bit of a flag here, if you will. So, and this is normal after such a strong move to the upside for a sector or a stock to basically trade sideways for a bit of time and consolidate. And just a couple of days ago, we got the breakout. So this can potentially, as you can see, we've had a pretty big move to the upside. And if you project that out, there's a big amount of opportunity to the upside. And it's very early days here in this particular rally. 138 also represents the all-time high here for IBB. So if you go back here in IBB, you have to go all the way back to 2015 to see this all-time high. See this all-time high? That was back in July of 2015 at 133. It just broke out above it with some meaningful moves to the upside. As you can see, it touched the 20-day moving average, 20-week moving average, broke out higher. So this is really where we see a potential move here in IBB. Now, this is predominantly due to the increase in spending and investment into pharmaceutical and biotech stocks to try to come up with a solution or vaccine for the COVID-19. Again, as far as which company is going to do it, whatever company comes out first is likely going to see significant gains. However, there is a very, very broad base of companies that are currently all competing for that. So from my perspective, it's hard to pick a specific name. I much prefer playing the broader index and playing for the playing the broader index rather than picking a specific name. So IBB Biotech Index, certainly one that I'm going to keep an eye out for. So that's what I wanted to show you guys here today. There are a lot of things that are currently emerging that are important to take a look at. COVID-19 trends, certainly one that to pay attention to. Corporate travel trends, also another one to pay attention to. IBB biotech, certainly one to look at. So any questions here? I have a couple of minutes here before I have to jump here. One question here about Kroger. So, you know, the grocery stocks, they have not been doing particularly well over the past couple of weeks. If you look at Costco, you look at Kroger's, they've really lack any type of momentum, especially when the markets are moving higher and they're moving sideways. That means they're actually falling behind. So I don't particularly like this. You know, we haven't seen any increase in terms of grocery spend. We've actually seen a small decrease as a lot of people stocked up during COVID-19 have excess supply. So I don't particularly see a strong catalyst here for Kroger or even Costco. One question here about Lyft here. So one of the things that, you know, as far as my Lyft trade on CNBC, for those of you that followed it, is I was looking for a $35 support, which happens to be both a visual horizontal support line as well as the 20-day moving average, and I was looking for that bounce higher. You know, yesterday it did break lower, but it had a pretty strong accumulation candle here, and it looks like it's about to open up just shy of 35. I'm holding on to this trade right now because my break even is just above 35. I'm looking for another continuation, but if it stays a few more days below this 20-day moving average, that's when I would cut my losses and get out. What is your sign to go long SPY? So I'm already long SPY by selling put credit spreads here because, again, you know, I see these as buy the dip opportunities. Every time it reaches these 20-day moving average, these are opportunities to sell put credit spreads. So I'm not long. I'm basically no longer bearish on this particular name. Again, the levels that I refer to is 318. That would be the first level, and 323. If we can get it back above those levels, we're going to probably get back to 339, which was the all-time high from February. Would you recommend selling puts versus buying bonds as an income strategy? So selling puts is not really an income strategy. You know, if you're looking for an income stream, fixed income certainly is an attractive place. LQD, TLT, even HYG. You know, I would prefer to be an LQD. As far as if you're looking for bond yields, that would be my preference as far as income. As far as selling covered calls, that also makes a lot of sense if you own some stocks to sell covered calls, especially when premiums are so high and you have VIX trading at 30. You're gonna capture a lot of income, from selling covered calls. Cash secured puts are for stocks that you want to purchase. So unless it's a stock that you really want to purchase, you know, selling puts allows you to purchase those stocks at a discount, but it's not really considered an income strategy per se. So with that, I want to thank everyone for taking the time out here this morning. I really hope that this was helpful in giving you a better understanding as to how we're viewing the markets and what we are currently seeing in terms of opportunities. I know there were more questions and I didn't get a chance to get through all of them, but thank you so much for joining me this morning, and I hope to see you guys here next time. Thank you so much and have a great day.